Hi everyone! So today we are diving into another extremely competitive sector in China, automakers. So this video will be about Geely, but soon I will do another video about BYD, so you'll be able to compare the two companies side by side. Before we start, I want to define the scope very clearly, because Geely can mean two different things. In this video, Geely refers to Geely Automobile Holdings, the Hong Kong listed company. That's the perimeter we are analyzing: the financial statements, the operating performance, and the shareholder returns. Now, you will also hear people talk about Geely Holding, the broader group with multiple automotive assets around it. That wider ecosystem matters strategically, but it's not the same thing as the listed entity we are valuing today. So I will stay disciplined. Our base case is the listed company, and will bring in the wider group only when it helps explain platforms, technology, or brand strategy. Inside the listed perimeter, think of a story as two engines: Geely, the mainstream scale brand, ZEEKR, the premium pure EV brand. With that scope clear, we can move to the history and key milestones, because that's where the logic of this group really starts to make sense. Geely's last decade is basically a scale, reset, reacceleration story, and the key driver behind that is the transition from a mostly ICE business, classic gasoline internal combustion cars, to a lineup where NEVs, EVs and plug-in hybrids matter more and more. The company started framing that direction early with the Blue Geely initiatives, launched in November 2015, which was explicitly about building leadership in new energy technologies. On the chart, you see the first chapter clearly. Volumes rise from about 0.5 million units in 2015 to around 1.5 million by 2018. And in 2018, the group reported 6.2% market share in China's passenger vehicle market. Then, the curve goes into a flatter regime around 2019-2021 before the second chapter kicks in. The electrification push becomes more structured and the portfolio gets cleaner. A good way to understand the brand evolution is this. Geometry was introduced as Geely's pure electric brand in 2019. Basically, an early attempt to build an EV identity. Later, Geely moves toward a more concentrated approach. ZEEKR is created as the premium pure EV engine, incorporated in March 2021. And its first mass-produced model, the ZEEKR 001, began deliveries in October 2021. And for the mass market, the group builds Geely Galaxy as the core NEV platform, and in October 2024, management made that strategy explicit by merging the Geometry series into Galaxy, meaning Geometry stops being a standalone brand and becomes a series under Galaxy. That's why the final part of the chart matters. The company exits the flat period and hits a new record in 2024, 2.11 million units, up 32% year-on-year, which is the visual proof that Geely's product cycle and its electrification restructuring are translating back into scale. At the simplest level, Geely is an integrated automaker. It designs vehicles, engineers platforms, manufactures, and then sells through its distribution channels. And management actually reviews the whole company as one single business segment, because all activities are tied to the same auto value chain. And as we defined in the scope, the listed perimeter is built around two major brands, Geely as the scale engine and ZEEKR as the premium pure EV brand. Within the Geely brand, the product structure is now clearer. China Star for the fuel ICE market and Galaxy for mass market, mid to high-end new energy vehicles. And when you look at the P&L, Geely is not only selling cars. Revenue is mainly automobiles, but it also includes parts and components, battery packs and related parts, plus R&D and technological support services, IP licensing, and even collaborative manufacturing income. These side streams matter because they show Geely is also monetizing its engineering and platform capabilities. For example, the company explicitly discusses providing R&D tech support and IP licensing to partners like Renault Korea and Proton and other Geely holding brands. Finally, the fuel versus EV transition changes what the business model requires. More software, more electronics, more platform investment, and you can see that in R&D. What's striking here is the step change in commitment. In the early years, R&D was running at roughly 2% of revenue, basically 2015 to 2018 on the chart. But today it's closer to 4%, so the intensity has roughly doubled. And because revenue itself is much higher than it was back then, the absolute R&D budget has exploded, from under 1 billion RMB in 2015 to over 10 billion RMB in 2024. So this isn't just a higher ratio, it's a different level of investment firepower behind product, electrification, and software. One important piece of the EV business model is batteries. But Geely is not vertically integrated like BYD here. Geely's battery setup is mostly supplier-led, but reinforced by a few strategic tie-ups to secure supply and move faster. The key one is CATL. Geely and CATL formed Times Geely around cells, modules, and packs to protect the EV ramp. In parallel, ZEEKR has a planned battery JV with LG Chemical, while Geely keeps the integration layer in-house. Net partnerships upstream, integration at home, shaping both cost and product performance. Now, in the market, Geely is fighting in China, where price pressure is constant and NEVs drive growth. It reported 7.8% PRC wholesale share in 2024, then 11.2% in H1 2025, with NEVs now over half of its PRC mix. Next, as electrification becomes standard, the edge shifts to what customers feel daily: cockpit experience, software update speed, and driver assistance. That's why Geely is pushing a more unified ADS approach and expanding its cockpit software stack across more models. Finally, these are advantages, not a moat. Features get copied fast, and price wars can crush returns. So the structural bet is mainstream scale, a premium learning loop via ZEEKR, then transfer the learnings across the broader lineup. Now let's validate the story with the numbers: scale, profitability, and earnings power. Revenue expands massively over the decade, from 30 billion RMB in 2015 to approximately 240 billion RMB in 2024. And 2025 is continuing that momentum. H1 2025 revenue was 150.3 billion RMB, and Q3 alone was 89.2 billion RMB. So the first 9 months already reached 239.5 billion RMB. Geely is still China first, but exports have become meaningful, especially Eastern Europe and parts of Europe. And that introduces a real policy risk. As Chinese exports get more competitive, regions like Europe can become more restrictive on imports, especially in autos, where local incumbents are politically sensitive. This chart is the cleanest reality check on Geely's business quality through the cycle. EBITDA margin climbs to a peak around 2017-2018, then compresses sharply as the market turns more competitive and pricing pressure rises, hitting a low point in 2022-2023. What's encouraging is the rebound in 2024, which suggests the company can still generating operating leverage when product mix improves and cost discipline holds. Finally, EPS is the shareholder summary, but 2024 needs one caveat. Financial year 2024 EPS was boosted by a large non-recurring accounting gain linked to the formation of Horse Powertrain. Concretely, Geely contributed its wholly owned powertrain subsidiary, Aurobay, into a new powertrain joint venture with Renault and Geely Holding, and in exchange, the group ended up holding a minority stake in the JV rather than fully consolidating the business. That's why I prefer a normalized rolling EPS, which puts earnings power closer to 1.17 RMB. On the balance sheet, the takeaway is straightforward. Geely's financial structure looks solid. The group is in a net cash position in 2024 with roughly 36.9 billion RMB of net cash, which gives it flexibility in a market where conditions can change quickly. CapEx is the second fixed cost of competing alongside R&D. On the chart, it stays structurally high, mostly 6 to 8% of revenue, because Geely has to keep investing every year to stay relevant in China autos. Working capital is structurally negative. Payables tend to be larger than inventories and receivables, which is a scale benefit in manufacturing, but it can swing fast when payment terms change or the supply chain gets stressed, like in 2020. So the free cash flow chart is basically working capital swings minus capex. 2020 is the outlier because operating cash flow collapsed to about 1.6 billion RMB versus 12.5 billion RMB in 2019, mainly as trade payables turned into cash outflow when Geely accelerated supplier payments after COVID. With capex still around 7 billion RMB, free cash flow mechanically went negative. The rebound in 2024 reflects stronger operating cash flow and lower capex intensity, but it's important to separate that from the EPS story. The financial year 2024 EPS boost includes a large one-off accounting gain, which is backed out of operating cash flow as a non-cash adjustment. That's why I treat financial year 2024 price to free cash flow as directional rather than a through-the-cycle base. On capital returns, Geely stays conservative. The dividend yield is around 1.9% at today's price, and in 2024, the payout ratio was approximately 19%. The company also announced a 2.3 billion Hong Kong dollar share buyback program, roughly 1.3% of market cap, but it won't materially change the share count on its own. At today's price of around 16.9 Hong Kong dollar, financial year 2024 looks like approximately 9x PE. But that headline multiple is distorted by the one-off. Using a normalized rolling EPS, earnings power is closer to 1.17 RMB, which implies roughly 13x normalized PE. Alright, let's quickly summarize and wrap up. What we've seen is a company with real momentum. The standout point is market share. Geely gained share sharply in 2025 in one of the most competitive auto markets in the world. That matters because in China autos, you don't gain share by accident. It usually means the product mix is working, the pricing is competitive, and the execution is improving. At the same time, we need to stay realistic about the sector. Auto is cyclical, price wars can return quickly, and the export leg comes with policy risk. Trade rules can tighten, tariffs can move, and access to overseas market can become more difficult. And to be clear, that's not a Geely-specific risk. It applies to most Chinese automakers as they expand internationally. On valuation, I would also stay cautious with the headline multiples. The 2024 EPS and free cash flow benefited from a favorable setup. EPS was boosted by a large non-recurring accounting gain linked to horsepower train, while free cash flow benefited from supportive working capital and lower capex intensity. So if you normalize those drivers across the cycle, the true PE and price to free cash flow are likely higher than what the financial year 2024 snapshot suggests. Personally, I don't own the stock right now, but it's a name I'm watching closely, and it sets up a good comparison for the next video, which will be BYD, so we can look at two very different approaches to winning China's EV market. Thanks for watching this deep dive until the end. If you found it useful, feel free to like, subscribe, and share. And if you want to dig deeper into the auto sector, especially the EV supply chain, check out my CATL video. It's the perfect next watch.